Are we finally in a place where the markets can get a little bit of respite? We are looking at a situation here where it looks like we have a little bit of a better day for financial markets. It looks like we have a little bit of a better day for stocks. It looks like we have a little bit of a better day for risk appetite in general. And so the interesting question then for investors here, seemingly, are we actually starting to see a bit of respite? And not surprisingly, the situation in the Middle East is not looking any better, but perhaps we are finally looking at something that could be a little bit of a relief. And yet, the macro event risk this week suggests a bit of a divergence might be in the works. So looking at the situation here, we seem to have a bit of a rotation that might be shaping up. As ever, this is Macro Money. I'm Ilya Spivak. This is our weekly view on the global macro catalysts that are going to be driving markets in the next 5 days. As ever, if you're watching this on YouTube, jump into the comments, share your thoughts. What are you thinking about? What might drive markets this week? And we will incorporate your thinking into the show going forward. So let's consider what we have on the docket here and consider, are we in a kind of rotation here where perhaps as things settle and the various catalysts that have been pushing markets this way and that over recent weeks are priced in and even out, we're looking at maybe something of a readjustment as to what assets do well and what ones don't into the end of the year. And we begin our conversation with the situation that we have here in Europe. The first sort of thing that we need to consider here, seemingly, is the release of Eurozone GDP and CPI numbers. And the initial situation here that we're looking at is the view on the CPI bit. As you can see here, the expectation is for a relatively significant shift into a less inflationary setting. So moving down from a 4 handle on inflation down to just 3.1%. Now, that would, of course, comport with the thinking from the ECB last week, where the focus was very much on this state of affairs in the economy. As we can see here, as ever, for PMI data, 50 is the middle ground. Above 50 is growth. Below 50 is contraction. And the faster the growth, the further higher you go above 50, the faster the contraction, the further lower you go below 50. What we see here is for the Eurozone, that composite index bringing together manufacturing and services is down for 3 months here through the recent data. And that, of course, suggests 4 months, actually, once we include the latest preview PMIs for October. And we get this sense that there might even be something of a downside surprise on the GDP part of this reporting. The expectation is that we're going to come down from 0.2% growth in the second quarter to flat in the third. When we get that data, looking at this, it might end up looking negative. And indeed, German GDP just over the past 24 hours came out, and it was indeed negative for a second consecutive quarter to put Germany now into a technical recession. That's the Eurozone's largest economy. So with that in mind, and with CPI seemingly starting to really come in as rebasing from last year's pop in energy really runs through its course, we get to a situation echoing the ECB's language last week, signaling that they are done raising rates. Here's the current expected policy path for the ECB. We can see here rates are seen holding at 4%, at least for the next 3 months, but relatively soon into next year, 6 months from here, we start to see the beginnings of a tilt toward rate cuts. So somewhere between April, May, it looks like, the first cut is on the menu. So at least for the ECB's part, it looks like the data this week is going to confirm their instinct that perhaps it is time to call it on this tightening cycle and start to give this battered economy some relief. It's a similar story when we get into the Bank of England monetary policy announcement later this week. And just by way of a little bit of a programming note, we'll do the European portion here first and then jump over to the U.S. side. The Bank of England announcement is actually coming on Thursday. There'll be some other U.S. event risk before then, but we'll bucket these together in the interests of our story that we're trying to tell here. So looking at the U.K., next, we get a sense that here, too, is a very similar story. Again, we're in contraction mode. You can see the composite PMI here well under 50. So we're shrinking here as well. And not surprisingly, with that in mind, the Bank of England is also expected to keep rates unchanged. And we can see here we are at 5.25. We're expected to sit there through the next 6 months. And it looks like a little bit later than the ECB, but nevertheless, soon enough next year, we are looking at some rate cuts. So maybe about one cut by the second half of next year. So you can see here we're at 4.93 by a year from today, so October of next year, or late October of next year. So it looks like here the rate cuts might be a little bit later coming, at least as far as current expectations are concerned. But you can see the curve, the solid line is the current one. The dotted one is since the last Bank of England meeting, and the small dots there are a week ago. You can see that there's been a dovish shift, in particular, as you get to the 6 months out, 1 year out space. It's very similar to what we see with the ECB. Relative to the last ECB meeting, which of course was just last week, and relative to a week ago, which was even a little bit longer, we have a very clear dovish shift. So here also might be a similar story. This central bank might also be ready to switch gears and start to provide stimulus. Now, it does look like it's gearing up to do that later than the ECB, but of course, this is where listening to what the Bank of England has to say will be critical. And any changes in when policy might actually start to give us rate cuts, and if there's an upshift there to bring it closer in time, well, then maybe we get a negative response from the British pound, but perhaps something else could also be at work here, adjacent to what we saw with the ECB last week, which we'll get to in just a moment here. Next on the docket is the U.S. portion of the week's economic data, and here, not surprisingly, first and foremost, the focus is on the Fed. We're going to get another Fed policy announcement here. They haven't met since the fateful conclave in September. What we see here is, again, no expectation of a change. Current rates at about 5.4. We expect to hold there for 6 months. We expect the first cuts to follow. At this point, the first cut is priced in no later than July. And it looks like we have anywhere between 50 and 75 basis points on the docket for easing next year. So if we're at 5.4 now, that's in a 5.25 to 5.5 range. The Fed's policy is to set rates in a range of 25 basis points, upper bound and lower bound, and a quarter of a percentage point between them. So looking at this, 538, which is the current median rate, is the midpoint between 5.25, 5.5. If we look a year out to 488, that's between 475 and 5. So if we look at the upper bounds here, that's a shift from an upper bound of 5.5 to an upper bound of 5. Or alternatively, a shift from 5.25 lower bound to 4.75. So either way you slice it, you're looking at about 50 basis points in cuts between now and this time next year. Now, we heard from Jay Powell, the Fed chair, 2 weeks ago, basically endorsing this idea and suggesting that the Fed may be ready to call it on rate cuts, or on rate hikes rather, even as it holds rates higher for longer, whatever that means. The Fed has been kind of coy about its version of what longer means. But the speech that he gave was a nice contrast and a pointed one from the situation as we saw it with that fateful September 20th FOMC. And you can see here, when that FOMC occurs, you get a surge in long end bond yields. The front end keeps holding. That's that higher for longer. So no more rate hikes. The 2-year yield idling here, that's the one that's the most sensitive to near-term Fed policy, and it's not going anywhere, suggesting the Fed is done. But longer-term rates have gone higher, and as we can see here, much of that rise seems to be attributed to a rise in term premium, which means that investors are essentially demanding greater compensation for lending over a longer period of time. They're saying, if we're going to lend money over 5 years, 10 years, 30 years, we want compensation for the extra uncertainty, additional compensation for the extra uncertainty that might occur in that longer period of time. This is a very different mindset from the kind of perpetual decline in both inflation and interest rates that collectively categorize the 40-plus years leading into COVID. This looks quite a bit different. This looks like the markets looked at a global recession that is gathering. They looked at a Fed that has inflicted a lot of tightening on the U.S. economy. And they looked at the summary of economic projections where the Fed said we need 50 basis points more rate hikes than we originally thought, that was released with that September meeting. And they said, okay, well, this means more uncertainty, because a global recession plus higher rates equals danger. And so what we ended up with was this rise in term premium and this pushing up of long-term bond yields that Powell then said 2 weeks ago at that Economic Club of New York speech has probably done the Fed's heavy lifting on those 50 extra basis points in rate hikes already. And so the actual further tightening may not be needed. So with that in mind, the Fed looks like it might be done. But of course, how it presents that idea, how it ultimately paints that picture will be very, very interesting, because the question, as ever, will be, okay, you're done, but when's the cuts coming? When are you going to actually give us some relief? And a big part of that conversation will actually be data released on Friday covering the U.S. labor market. Here we're looking for job creation to slow a bit, down from 336 jobs added in the previous month's report to 180,000 this go around. Jobless rate seen holding unchanged at 3.8%. And it's really that jobless rate that seems to be the key for markets. And that's because the Fed's entire mantra since the beginning of this tightening cycle has been, we need to squeeze inflation out of the labor market. This is where it's sticky, which is a chart that we come back to frequently here. This shows that while overall CPI has gone down significantly from 9 to less than 4% on headline, from nearly 7 to 4 on core, the employment cost index has only come down from 5.1 to 4.5. So we're talking about something that is at this point down less than 1%. And so with that in mind, we notice the still lingering disparity in labor supply and demand. We still are looking at a significant deficit in labor markets. That's helping to bid up wages. It's not quite as extreme as it was back in 2021 or last year. You can see those were the peaks in this deficit where the blue bars reach down furthest toward the bottom of the chart, second half of 2021 and into 2022. So you see there lots and lots of demand for labor and, of course, wages reflecting that, and those wages now being locked in, being a source of sticky inflation because, of course, the price of goods might adjust for inflation coming down and for demand easing, but wages don't. They're contractually set. And so what the Fed seems to be looking for here still is some kind of deterioration in the labor market to convince them that they've beat inflation in earnest. And looking at the unemployment rate here, which has gone virtually nowhere since the middle of 2021, notice, by the way, the same kind of emergence of this deficit from about the middle of 2021 is also the place where the labor market seems to reach steady state for the jobless rate. Right around the same time, it seems to basically anchor around current levels, a sort of range between 3.4 and 3.8. And so we get into this situation where if this jobless data is expected to come in about this, and that's what the Fed knows, and that's what the Fed has seen, then the message out of policymakers' mouth might be, yeah, we're basically done. We're probably not going to tighten any further. But until this jobless rate goes up, and until we see the labor market squeezing this out of it, we can't really end a higher for longer bias. We have to stay at elevated rates and let the pain set in. And this is where all of these things from Europe, both the Eurozone and the UK, and the US seem to tie together. If we look at how the overall global economy is doing, it is doing relatively poorly. We see that there was a pop in service sector activity at the beginning of the year, about the first half. That has now fizzled. And we are now looking at global growth basically near standstill. 50.5 is just a hair above that 50 middle line. So we're very much looking at a global economy that is decelerated to within a hair of a coordinated global recession. At the same time, things aren't seeming to be getting worse than expected. And this is, of course, the key for financial markets. It's not that things are good or bad. That's not what generates market action. Investors shape expectations, good or bad. And what tends to drive volatility, what tends to drive asset valuations to go up or down is the difference between expectations and reality. So if something comes out worse or better than expected, then people have to adjust portfolios accordingly. They have to rebalance for a reality that doesn't necessarily comport with what they had allocated on the basis of a world view that was different from what actually occurred and has now become different because the next steps after that deviation obviously give rise to new expectations and a different path forward. So in that sense, markets don't so much care that things are bad, it's that they're not getting worse. And that seems to be the message here, looking at the Citi Economic Surprise Index. It's suggesting that for the global economy as a whole, for developed markets and emerging ones, the story since basically July, August has been getting better in relative terms. Not because the economy is getting better, but because expectations have been so downbeat that economic reality has not really endorsed it. It's shown that things have actually become relatively better and now tend to outperform relative to forecasts. Again, not because things are good, but because the reality of the situation is less bad than what the expectations were calling for. What this speaks to is probably a risk-on environment. In an environment where things aren't getting worse, investors might be inclined to seek exposure to risk, to seek maximization of returns, rather than some sort of a coordinated rush to safety where correlations go to 1 and everybody is fleeing to cash. But U.S. markets may not be high on the list for where things are getting better because, as we've just discussed, the Fed might be reluctant to ease quickly because the labor market hasn't broken yet. Whereas the ECB and perhaps the Bank of England might be ready sooner. And this is where it becomes important to consider U.S. markets are up double digits this year, whereas markets in the Eurozone and in the UK are down close to 2%. And, of course, emerging markets are down much more at close to 7%. So one would look at this perhaps and say, okay, well, if things are not getting worse, then the object of the game for me as a trader is to find the best performing in a world of improving prospects and go there. Well, the place that might be better performing, or at least in relative terms, might be a little bit better supported, is the place where stimulus in this coordinated global recession scenario comes sooner. If everybody is going to go down into a recession together, the first one out is the one that's going to attract capital. And when we consider that the Eurozone might ease much sooner than the Fed, and perhaps the Bank of England also, then we get into a situation where those markets, since they've been down and are essentially on discount relative to the U.S., they might start to see some rotation, where investors say, you know what, buying U.S. stocks here doesn't seem to make sense. The Fed's going to hold rates until the labor market breaks, perhaps. But these other central banks are ready to give us the sweet, sweet medicine that we've so longed for. And, by the way, those assets are cheap relative to U.S. markets. Now, that might be a push into those stock markets, but it might also be a push into those currencies, because to own those markets, one, of course, needs the underlying currency to buy those assets. And so parallel to what could be a turn away from U.S. shares into alternatives in the Eurozone, alternatives in the UK, even alternatives in emerging markets, there might also be a shift out of the dollar into those currencies. Now, that need not necessarily be a long-term thing, and there can be a great argument to be made for any risk-on adjustment here is temporary before a larger reckoning down the road as the global recession really bites. But at the current stage, there may be some relative value here in bargain hunting outside of the US. And so the markets may well shift to say, Eurozone markets, UK markets, emerging markets, but also the euro, the pound, the Aussie dollar, as a reflection of China and emerging markets more generally. Those might be heading higher against the greenback as the markets readjust and say, we want to be where the stimulus is. If things are improving, we want to be where the growth is. We don't necessarily want to be very defensive and own just bonds and cash. But when looking at risky assets, looking at stocks, looking at other sort of growth-linked vehicles, that there is a recession leads us to assets where that recession is likely to get relief soonest. And that may not be the U.S., as we're going to find out this week with a combination of the Fed and this jobs data. Whereas in Europe, in particular this week, that might be a more present sort of scenario. And so even as we saw, for example, last week, the ECB take a dovish stance, the euro didn't fall. And as a matter of fact, has tracked higher since. It might be a similar story more broadly going forward. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, talking about what happened in financial markets on a given day after the Wall Street close and what might follow next. I am on with Tom and Tony for First Call on Sundays, back on with Chris on Fridays for Futures Power Hour, writing for the news and insights portion of tastylive.com, and opining on the platform formerly known as Twitter at @IliasPivak. Thanks very much for joining. Good luck out there this week. Macro Money will be back tomorrow. Take care.